Hi, everybody, and welcome back to video number 2 in chapter 1. And when we left off, we were looking at these three basic types of questions that financial managers make: capital budgeting, capital structure, working capital management. But I wanted to show you down here speaker notes. Oftentimes, these speaker notes are very useful. Here's some of the questions you might want to ask if you were working capital management is how much inventory do you have or need? How much cash do you need? Should you sell on credit? What would the terms we would offer and when would we offer them? And how would we obtain needed short-term financing? And will we purchase on credit or will we borrow in the short term to pay cash? If we borrow in the short term, how and where should we do it? So these are very useful, and I wanted to point it out before we went too awfully far in this. Okay, we'll go back, bring this back down. Okay, so as we move forward then, what are the major, and look at our concept questions, what are the major capital budgeting decisions? What is the capital budgeting decision? Okay, and here's the answer. It's the process of planning and managing a firm's long-term investments. Then the next one, it says, what do you call the specific mixture of long-term debt and equity that a firm chooses to use? And that's going to be your capital structure. And the third question is, into what category of financial management does cash management fall? And it falls into the working capital management. And there we're looking about the receipt of cash, distribution of cash. I use the term cash in, cash out. And that's how we go. So as we move into the next section here, we have forms of business organization. And in this case, most large firms in the US are almost all organized as corporations. They could be a private corporation, but most are public. There are three different types of business organizations that exist, and each has its own advantages and disadvantages for the life of the business. So the ability to raise money and pay taxes are the key differences. So if I look at sole proprietorships, that's where one person is managing the business and owns the business, and away they go. But if there's two or more partners, then it's a partnership. But from the standpoint of pros and cons, my father was in partnership with Jim Bull, and it was known as Bull and Wilson. And that partnership by itself, Bull and Wilson did not pay taxes. But Dad, Jim, when they pulled money out of the business, they paid taxes based on the money that they pulled out. Okay, so however, both Dad and Jim were liable for any and all problems that their business might have created. So if Dad was a structural engineer, for example, and a bridge collapsed, he would be solely responsible for that. And if Dad couldn't pay, Jim would have to step in and pay, called joint and several liability. And so that is the disadvantage of a partnership. The other disadvantage is it doesn't have unlimited life. Both Dad and Jim have passed away, so there's no more Bull and Wilson. Corporations, I think of like a person. Corporation pays taxes as a corporation, but the owners have very limited liability. The liability that they have extends only to the cost of their stock. So if you bought it for $100 a share, the most you can lose is $100. Okay, so that's the advantage. Now, another big advantage of corporation is the ability to raise money. So let's get into this a little bit. Sole proprietorships, as I mentioned here, is a business owned by a single individual. And the advantages, simple type of business to start. It's the least regulated form of organization by far. And the owner keeps all the profits. Okay. The disadvantage is that the owner has unlimited liability, as I mentioned, and all business income is taxed at personal income levels when they are withdrawn from the business. The life of a sole proprietorship is limited to the owner's lifespan, and the amount of equity that can be raised is limited to the amount of the proprietor's personal wealth. So the ability to raise capital is very limited, and the ownership may be very difficult to transfer. Okay, let's go to partnerships. Same kind of thing here, except that they're owned by two or more individuals. I'll talk about general partnership here in a second. The advantages and disadvantages are basically the same as a sole proprietorship. And again, the central problem is the inability to raise cash for investing. So the unlimited liability for business debts on the part of the owner, okay, unlimited liability, limited life of the business, as I mentioned, with Dad and Jim both have passed away, so the business is no longer here, and difficulty of transferring ownership. Dad was successful in selling Boll & Wilson, such that it was at the time, and got some money, but it was still a difficult transaction to do. Okay, coming back here though, both Jim and Dad were general partners. Both of them had unlimited liability. But let's say I wanted to join the firm of Boll & Wilson, but I didn't want to have any liability. I can, but what I would offer is I could give them $100,000 or something like that. So they accepted me as a partner, but I'm limited to the extent of my investment. I don't have any personal liability as a general partnership would have. So it's an important distinction between a general partner and a limited partner. Okay. Now, the corporation is a business that is created as a distinct legal entity composed of one or more individuals or entities. So I think of it as a person, separate and distinct from its owners. And it has rights and duties and privileges of an actual person. Stockholders and managers are usually very separate groups. And I think you would know that instinctively if you've been around any corporations. The advantages are the ownership can be easily transferred. You can sell your stock, you can buy your stock, very easy. I worked for Chrysler Corporation, and in the lovely town of, in the lovely state of Michigan, and the life of the corporation here is still around. Walter Chrysler, I think, passed away in 1940 or something like that, but his name is still part of the corporation. And then there's limited liability for the stockholders, meaning that their liability extends only to the degree that they have invested in stock. They can't be sued for other things that the corporation might have done. Okay, significant disadvantages in a corporation. Double taxation. It means that the corporate profits are taxed twice. First, at the corporate level when they're earned, and we pay corporate taxes on them. And again, at the personal level when those profits are paid out in dividends, and you pay personal taxes on those dividends. There's one more that they didn't put in here, which to me is a huge one, and that is administration, especially for a publicly held corporation. In a publicly traded corporation in the United States, ones that sell on the Securities and Exchange Commission, you are required to comply with what's lovingly called Sarbanes-Oxley. And Sarbanes-Oxley is very, very expensive to do. I was the SOX coordinator in my last position, and we had to do 100 audits every quarter, more than 100. And I had to train all the people how to do the audit. And, then I'm supposed to conclude as to what those audits disclose. And then those 4 quarterly assessments by me are reviewed by our outside auditors. So it's quite the thing. Okay. So the corporate form has many variations worldwide. We sometimes call them limited or joint stock companies or public limited companies or limited liability companies. And the principle is the same, though. A benefit corporation is for profit, but it has 3 additional legal attributes. One, it has the accountability, referred to the fact that a benefit corporation must consider how its action will affect stockholders, employees, customers, the community, and the environment. Okay. And therefore, transparency means that in addition to the standard corporate reports, a benefit corporation must provide an annual report detailing how the company pursued a public benefit during the year. This is a for-profit, not a non-profit. So this is a little bit different, but it's pursuing a public benefit during the year. And there's factors that inhibited the pursuit of that goal, if there are any. And then 3, the purpose. That refers to the idea that the benefit corporation must provide a public benefit either to society as a whole or to the environment, rather than just simply having a goal of maximizing the current value per share of existing stock. Okay, so the goals of a for-profit company is to make money and add value for the owners. And so what are some of those possible goals? Well, some of them tend to fall into 2 classes. One is a profitability goal, and that's pretty easy to understand. Those relate in different ways to increasing profits. You can increase market share, you can increase sales, you can reduce costs, those kinds of things. But also, we have a goal that focuses on controlling risk and bankruptcy avoidance, stability, and safety. And risk enters into financial decisions more often than you might think, first coming in as a student in this area. So from a stockholder's point of view, what is good financial management decision? It is to maximize the current value per share of existing stock. Okay. So when we come back, we'll take a look at the concept questions involving financial management. Until that time, bye for now.